Like we're ready. So welcome to our YIS interview with Mr. Brian Murphy. Today we have Neil G, the winner from our Shark Tank contest. Neil comes to us from Cox Mill High School in North Carolina. And so last year he entered the YIS Shark Tank contest, and we are now doing our interview with an investor. And Mr. Brian Murphy has graciously joined us. And James is our founder of Young Investor Society. And I'm going to give it over to him to do a proper introduction to Mr. Murphy.
Okay, well, welcome everyone. Welcome Young Investor Society students, and you're in for a treat tonight. Those who attended the 2023 Global Stock Pitch Competition Gala got a sneak preview of what we'll hear today, which is to hear Brian Murphy's story, and it's my pleasure to introduce him. Brian Murphy is the founder and managing member of Portfolio Advisors. He is co-head of business development and investor relations. Portfolio Advisors manages $38 billion. And we were just discussing before this call that has generated returns above 18% annualized return through the long history of the portfolio. Brian graduated from Brigham Young University in 1986 and earned an MBA from Columbia University. One of the great things about this interview is our Shark Tank competition, as you're aware, talks a lot about entrepreneurship and pitching new business ideas to the sharks. And Young Investor Society, we talk a lot about investing. And Brian Murphy is this amazing intersection of a very successful investor, but also a very successful entrepreneur who built this widely successful investment firm, Portfolio Advisors, and can talk about both the entrepreneurship side and the investment side. And from a personal standpoint, tells wonderful stories, is so humble yet so successful, and just a dear friend of mine and Young Investor Society. So with that, I turn it over to Neil, who has been Brian Murphy.
So before we move forward, Neil, let me just mention that the last 60 days have been pretty exciting, because on July 1st, I closed the merger of Portfolio Advisors with another world-class company called FS Investments. And that creates a company with $75 billion of assets under management, and big enough that we could go public if we choose to do so in the future. But that allows me to step down as the president and become a senior advisor to FS Investments so that I can help that company continue to grow and scale. So I'm the founder still of Portfolio Advisors, but I'm no longer the managing member. I handed that assignment over to one of my top partners.
That's pretty cool. That's very nice. So Portfolio Advisors, how long ago did you found this, and what was your path to founding it?
So we started the business back in the kind of right at the end of 1995. So it was 28 years ago. And it was really interesting. People say, well, you must have been pretty young. I turned 62 years old yesterday. And so
Wow.
I was pretty young. And one of the interesting things was when I got out of Columbia Business School, I got a job at an investment bank. And I thought that would be a really good way to learn about a lot of industries, to learn all about, the financial statements, what makes successful companies succeed, what makes companies that fail go down that path. And I learned a lot. And I spent a couple of years in investment banking. When I turned 30 years old, I thought, well, gee, I've learned enough. I should be able to go start my own company. And it was a little ignorant, a little, wishful thinking, but it ended up working. We started a business when I turned 30 years old, and it was called Morris Anderson Investment Advisors. And I ran that for 5 years, but I realized that there were things that I wanted to do that my other partners didn't. They were much older than me. I was young, and they were in the twilight of their careers, and I was just really getting going. And so when I turned 35, I realized I need to do something different. And so I stepped out with another fellow and I formed Portfolio Advisors. So It's been a really, really fun kind of almost 30-year entrepreneurial exercise. Learned a lot, worked really hard, and we had a really successful outcome with this merger with FS Investments. So the
So it's
question
been
people always ask me is, what were the skills or what were the lessons that you learned from doing that, right? And the one is, I think to be an entrepreneur, you have to have some courage. You have to believe enough in yourself that you're willing to step up and take some risk. You want to manage the risk. I mean, there are some people that take crazy risks. I mean, it's kind of like bet the farm risk. If I do this and I fail, life's over. Don't want to do that. But I had learned enough that I thought I have enough connections that I should be able to find a lead client or two and be able to get that business up and running so it can be profitable very quickly. We won't need to take a lot about, third-party money and things like that. So courage mattered. Relationships mattered. The fact that I was 30 and that I had worked in banking, I had some very happy clients, that made a difference. So when I started the first company, one of my big clients from the bank said, "We believe in you. We believe you can do a really good job for us. We'll be your client." And so that made a huge difference. But they would only do that because I had worked with them for a couple of years and they saw what I had already added in value and that they could trust that a 30-year-old person could run an investment firm.
very, very interesting story. So it's been such a long path for you. So what was what was a big mistake that has stood out to you till today? And how did that change your strategy and thought process going forward?
Oh, you make so many mistakes in a career as long as mine. I think the secret is you never make a fatal mistake. You want to make
Mhm.
small incremental mistakes, but one of the things that I absolutely knew was true didn't necessarily prove out to be true over the entire length of my career. And I'll give you an example of that. There's kind of a story from Mark Twain, and it says that it's not what you don't know that gets you in the most trouble. It's what you absolutely know to be true and isn't that gets you in trouble. Because when you believe something's completely true, then you'll usually take much more risk and you'll be much more aggressive. And when it proves to be false, you kind of you learn you've bet the farm and you just don't have any money left or you don't have any reputation left. And so for me, I assumed that I could not grow my firm unless I was on the road meeting with people face to face. That you could only really convince people to invest money with you if you were shaking hands and doing it face to face. And I think there is truth in that, but I bet everything that would be the case. Now, it was a very successful method, but I was gone 5 and 6 days a week. I've flown around the world 250 times. I've been on 2,500 airplanes. My family didn't see me for long periods of time because I was growing this company. And the thing that really completely changed my view was the pandemic, because we ended up raising over $5 billion during the pandemic, all by Zoom. And it was like, okay, maybe we don't have to do it the way we've done it for 25 years. Maybe we can really do it differently. Technology's changed, the way people work and engage has changed. Let's use this new lesson that we've learned, that we were forced to learn, and let's pivot the way we try to run our business. And so today, we actually do things a bit differently than we had done for a very long time. So that wasn't a business mistake. That was a family and a personal life mistake. I probably could have spent more time at home and had a lot more fun along the way instead of being a workaholic.
No, that's very interesting how you were able to fix that mistake because of the pandemic. So, uh, switching over a little bit towards the perspective of me and other young investors, what would you suggest that we should try and learn at this age that would help us in the future, especially if we want to go into the finance field?
Whenever we interviewed young people, they would always say, "What are you looking for?" And I would always tell them, "Look, I don't expect you to be an expert in, say, my field, private equity or real estate or lending or any public equities. I don't expect you to be an expert there, but what I expect is that you were interested enough and intellectually curious enough that you started to investigate it and you've kind of concluded this is something that I think I could be good at and that I enjoy. And that's what you were mentioning to me earlier, that you really have enjoyed finance and investment analysis and that you think you could have a career there. So that's really important. And then the rest are just kind of fundamental things. Are you a hard worker? Are you a team player? Do you help build up the people near you, or are you selfish and you're trying to look good at the expense of others? We always look for team players. We think it's a gang tackle kind of a business. You have to succeed together. And many minds are better than a single mind. And so that ability and that desire is also important. Do you ask a lot of questions? Or do you just say, I know how to do this and I'm going to go ahead and prove it to them? Well, I always like when I work with a young person that they kind of tell me what they're doing along the way so that we don't find ourselves 3 weeks later and they happen to be wrong or mostly wrong. I like to be collaborative so that we can bounce ideas off and they can always be kind of fine tuning and adjusting so that they get to the right answer. They get there faster. It's a higher quality solution. And you have to be a little humble in order to do that. People that always think they're right are hard to work with sometimes, especially if you're a young person. You want somebody that's going to be a mentor and that's going to share their knowledge with you so that you can learn faster and do that. So I always tell people, have a great attitude, be willing to do anything. I teach a lot of college classes and I tell them, don't focus so much on how much money you're going to make in the beginning of your career. Focus on the skills that you need to learn and the relationships that you need to build so that when you do get to be 40 years old, you're really good. You've developed expertise and people look up to you and people respect you. And that's when you're going to really find yourself in the best position and when you're going to really be successful. Most of the money you'll ever earn in your life is after you're 40. It's really pretty small until then. So make sure that you're developing those skills and that knowledge base so that you are positioned to be successful. And, that attitude and that work ethic and that curiosity are really important factors in that process.
Okay, so that's pretty interesting. That's nice. So I wanted to ask you about how people can seek more opportunities through networking. So I know at your stage in your career, you have so many different relationships, and those have opened up so many opportunities for you. So what are some tactics and examples that you would give to people like me?
So one of the things that I found with my own kids is that their view of a relationship is different than my view of a relationship. They're so excited when they've got 5,000 people that follow them on Facebook or on Instagram, or they've got 200 people that they're connected with LinkedIn. Those are acquaintances. They're not relationships yet. They might be a window to develop a relationship. And I kind of view a relationship is do I know this person? Do I trust this person? Do we know each other well enough that we're willing to stick our neck out? Would this person be a reference for me if I was trying to get a job? Would they hire me? Those kind of things. And so those kind of relationships come about partly with time. And so if for a young person, I'd say, be involved in lots of things. You don't know whether it's someone who's in the band with you, or whether it's someone that was in the Boy Scouts, or someone in the YIS group, or wherever you're, someone at church, or wherever it is that you make friends. Those are people that you get to know because you have life experiences together. And you learn whether this is a good person or a bad person, whether it's a person that you can trust. Do they keep your confidences? Are they bright? Do they do interesting things? Do they do successful things? And it will follow through high school. It will follow through college. It'll follow through your early career, and you will build relationships. The nice thing is I've been able to build relationships just in the last couple of years. It never ends if you really want to get to know people and you want to build it. But social media is only a small piece of it, and it's not the be all end all. And my kids think this is how you do it. And it's like, not really. People always send me notes and say, hey, Brian, I see on LinkedIn that you know this person. Can you introduce me? It's like, hey, I've never met this person. I get 50 requests a week to be linked with people. And I know a couple hundred of them. I don't know the 8,000 people that have linked with me. And they're like, oh, darn, sorry. Okay. So, because it's a connection, it's not a relationship. But you'll know relationships because they will be critical. In fact, when I started Portfolio Advisors at 35, it was one of my relationships that I had as a client that allowed me to start it because they became my lead client there. And they gave my firm $1 billion to invest. And it was because we had worked really hard to develop that relationship of trust in the 5-6 prior years. And they were willing to effectively bet their career on this new startup that we could accomplish what we said we could. And so to me, that takes a little bit more substance. And so work on that substance part.
Well, it's very fascinating to hear the definition of relationship from your point of view. So I think I'm going to go into more specifics now. And my first question is, how do you perceive and manage the risk that comes with different types of investments, especially when analyzing companies?
Well, the first thing I would say, and having 130 people work at your firm and kind of talking to my friends and associates, people see risk very differently. And most people misunderstand it and mismanage it. And so lots and lots of people believe things are not very risky, and it kind of blows up in their face when they find there was a lot more risk there than they thought. There are a handful of people that think everything is risky and they don't do anything. They just don't think there's any outcome that will be worth the risk that they're taking. So I think one of the really key things in business and in investing is learning what the real risks are. Are they unique to this investment? And is there a way for me to lower the risk? Warren Buffett has a great saying where he says, it's only risky if you don't understand it. And so there are things that Warren does that people think, I would never do that. That's crazy. And yet he can do them in his sleep because he understands it so well, it's not risky for him. And I found the same thing in my career. There were things that I've done that people thought, are you out of your mind? I thought, no, this is really a high quality bet. This is something that I thought had asymmetrical return potential. And so one, you got to figure out, what are the risks? Are there ways for me to change the outcomes? And for the ones that you can't change, then the question is, if there's a negative outcome, how bad is it? I mean, if you have a 95% chance of losing all your money, that's probably not a risk you want to take. If the chance of if you're right, if the chance is you'll make 5 times the money, and if you're wrong, then you lose 10%, that's a pretty good bet. And then you work real hard to make sure that you do the very best you can to manage the good risks and reduce the bad risks. And I think that's true of investing. It's true in life. It's true when you pick a college. And I have friends that spend $500,000 going to school, and they didn't get a better education than some of my friends that spent 30. So sometimes there's a lot of marketing that goes on, and it doesn't help you to understand the risk. And that's why we need to learn to see through that and figure out what really is the risk, what are the rewards, and what are the trade-offs that are worth it.
Yeah, I understand.
One
So
really
in the
interesting,
present day, we've
I was just going to say one interesting
seen
example. I always told my kids I wanted to short Tesla, but I never did because it kept going up. And I thought that could hurt really bad because things can go up a lot. And so I talked about it, but I never did it. One of my sons manages a portfolio for me, and he was showing me his returns, and his returns were really very good. And I said, so what drove your returns? He said, oh, I bought Tesla. And I said, well, wait a second. You heard me say so many times that you shouldn't buy it, that we should short it. He said, yeah, I didn't agree with you. So he said, here's why I bought it. And I made 15 times our money. And so he was right. I was wrong. We both had very good reasons, but that's what makes the world go around. That's why investing is so interesting, is that so often there is not one specific solution. And in that case, he was right. That's why we have diversified portfolios. If you put all your money into a short on Tesla, you would be really poor right now. So
That's a cool story. So from your experiences and from seeing the present AI bubble that, or supposedly AI bubble, what do you think the impact of AI could be on other investing firms and investing advisors?
well, right now, it feels like AI is a lot like back in the late 90s, early 2000s, when anything that had a .com on it had a really high valuation because everyone said, this is going to change the world. And you know what? It did. But the earliest companies, many of them went bankrupt. And so it was really saying, okay, who gets this? Who has a reasonable valuation? And who's going to be able to use it to become one of the dominant players? And I feel the same way about AI. I think it is an amazing technology. It will fundamentally change the way we live our lives. I recently read one book, and they believe that 40% of all jobs will disappear because of AI, kind of like autonomous driving and things like that. But it will also create many, many additional jobs in other areas because there's always going to be room for the social part, right? There are many, 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 many people who would not be comfortable taking all of their investment advice from a robot. And part of it is making people comfortable and confident and trusting. And so, for example, in my business, if I raise a fund, my fund is asking people to lock up their money for 15 years. That requires a tremendous amount of trust. Now, somebody might let a computer day trade their account, or they might be willing to take some stock selections from a computer, but they probably won't feel as comfortable if they want a personal financial kind of plan, which includes their beliefs and their family needs and all of these other things, because many of those are softer issues. They're harder to put into and analyze in a computer. And so I think that I think AI will take over a bunch of functions, just like the big data has taken over some of the functions. And just as computing power has grown, lots of hedge funds have massive amounts of computers that are calculating the arbitrages that are available in the market. But there will be many other things that you need humans for. So I don't think that the financial world will be as impacted as much as, say, quite a few of the, say, manufacturing things where robots can do the work very, very well. I have an investment in a company that is developing a robot that will basically pick things at an Amazon warehouse. And so it would displace an Amazon worker, but it can work 24/7. It can replace its own batteries. Everything feeds in electronically. It never gets sick. It doesn't need benefits. And so those kind of robots will be very, very much in demand, and they'll be worth a lot of money. So if I was an Amazon worker, I'd be nervous. But if I was the manager of the warehouse, I probably wouldn't be worried at all, because somebody's got to make sure that the robots are working. So
Yeah, that's a unique perspective on AI. I didn't consider the fact that new jobs would open up as AI took over some of the old jobs. So,
they're all programmed. You got to, the problem with AI is it's all based on who programmed it, what did they want it to do, what biases did they have, and so I think there will be lots and lots of human touch to make sure that the things do exactly what people want.
mhm, okay. So my next question is a little broader, and wanted to ask you that what are some upcoming trends in the business world that you see that could impact the way companies run? And what are some that you're excited about?
Um, well, if we jump back to AI for a second, where I think AI will be really interesting is where it does help increase efficiencies and increase margins. And so companies that are able to use it throughout their business to increase their margins will get a very high premium compared to those that can't, because they will have more and more dominant positions. And so I think that will be important. You look at many kinds of companies. If it's a SaaS business, they're basically, they have very, very high margins because they, kind of the old days where you had a computer program and you had a software and you mailed out the package and everybody had to load it up. Very, very different model than people that are paying for a service and they're paying a monthly subscription. Those businesses can scale with a lot less capital and they can scale with a lot higher margins. And we're moving to a society where people are very comfortable with that model. I love the sharing society where, people say, well, you're going to go buy another car, or you're going to buy a second home or a third home or a fourth home or whatever it is, or you're going to buy an airplane, or what are you going to do? And the answer is, there are so many of these assets out there that are not being utilized very efficiently. And so buying a jet and putting it in a jet pool, or buying a car and putting it in a car rental pool, or putting your home on VRBO, or renting a home on VRBO instead of buying a second home in Hawaii. There's so many things that exist today because of apps and phones and the internet that you can do that completely change not only the way the business works, but also the way you live your life. People can live a very, very good life just by renting instead of by owning many assets. And so I think that those things will continue to evolve and continue to do better. I ride a lot of Ubers, and I'm always asking the Uber driver, how long have you done this? And how much do you make? And is it different than what it was 2 years ago or 5 years ago? And one is I just am fascinated on how the business models work and where it's working well and where it isn't. And part of it is my clients made a couple $100 million because we were an early investor in Uber. And so it's just kind of fun to see how is this growing and how is this changing. And, for the longest time, Uber didn't make any money. I'm not sure if today it still makes any money, but yet it's a big company with a lot of usage and a big market value. So some of the business models are a little different than a traditional one. I'm kind of a value investor. I put in a multiple on cash flow because I think that could be dividends, but there are many, many business models that trade off of revenues, not profits.
That's interesting. So you said there's business models that trade off of revenue. So does that mean that their profits are much lower, but there's something about the revenue that just strikes investors?
I think it's the moment in time. I think that people that are willing to pay a multiple of revenue, if they believe that the company can have tremendous growth and will ultimately produce the profits. And so, a startup can generate revenue, but usually it has too much overhead to generate a profit. And so you would say, well, based on an old-fashioned methodology of only based on net income or only based on EBITDA, this company has no value. Well, we know that it has value because it has customers and it looks like it can scale and it could be incredibly profitable. Google was not profitable when it started. Apple was not profitable when it started. They certainly are now because they've gotten to that scale and they're just some of the most biggest cash flow generating companies in the world.
Makes sense. So I think we're nearing the end, but I'll ask you a couple more questions. So one question I wanted to ask you was, in the course of your investing career, what was your favorite trade or stock, and what qualities about it made you invest in it?
So one of the best trades was we bought NVIDIA. And so we bought that company about 8 or 9 years ago. And the reason then was that it was just a really, really great chip maker. And the chips were becoming used in more and more and more industries. What then made NVIDIA just skyrocket was that its chips were picked up and they proved to be the best chips for mining cryptocurrencies. And there were just massive numbers of chips that were required for all of these big farms that were there using to mine Bitcoin or Ethereum or whatever. And that really caused it to get some scale. But then it kind of slowed down and even dropped because the crypto market proved to be very volatile. And so it wasn't a consistent buyer. Well, then all of a sudden people realized there's not nearly enough computing power to fully engage these artificial intelligence businesses. And they found that one of the very best chips for doing that is NVIDIA's chip. And so it's just taken off in the last couple of years. I mean, it hit $1 trillion market cap, but I think we made 25 or 30 times our money on that. We were right on the growth prospects, but we had no idea that some of the biggest drivers would be new industries that would cause it to happen. And so that's where, you know, kind of watching where the trends are going. If, you know, it's hard to bet against Wall Street, it's hard to bet against the consumer, it's hard to bet against a lot of things where they are truly demographic or major changes. And you don't have to be 100% right to do very, very well if you get the trend correctly and you buy the right companies. That's one of the reasons why people have done really well in the stock market. You know, if you were in the NASDAQ over long periods of time, you've done very well. Same with the S&P, and that's because you're long equities, you're betting, you know, pro-American, you're betting pro-global, and all of those things. But there are big enough, strong enough companies that are driving it, but not always. One of the things that I always give the college students as an example is you can be almost completely correct and still lose. So for example, when the pandemic hit, we have a very big buyout portfolio. So I had the chance to talk to 50, 60 CEOs and say, hey, how's your business really doing? And a lot of businesses were flat to down. There were some unique ones, like we had an investment in Zoom. It took off because the pandemic was perfect environment for them to show the world that this was a key technology. But by and large, most companies were not doing well. And so I thought, well, how do I play this? So I thought, well, I should short an index. And if the market goes down, then I'll make money. And I thought, well, how much do I believe in this? And I thought, I'm pretty confident. I've talked to a lot of CEOs. I'm very confident. So I'm going to go ahead and short the triple Q because it's a triple thing. So if I'm right, I'm going to be really right. And then something happened that I just never conceived of. There were 5 stocks, the FANG stocks, that did incredibly well. And they ended up driving the S&P to record levels. So even though if you took those stocks out, the S&P was down and I would have made a bunch of money. But because of them, I was wrong and I lost a bunch of money. And so there were 5 other indexes I could have shorted. All of those I would have made money. And so, you know, it's just a good example that you can be 95% right and still lose on a trade. But then there are many other ones you can be 95% right and you can make a ton of money. So that's why never bet the farm, diversify your portfolio, have a handful of conviction ideas, and spread your investments around because there are things that happen that you can't control. There are risks that you didn't understand correctly. Things can happen that'll surprise you. And you can be surprised positively or you can be surprised negatively.
Okay, that makes sense. So the risk in your scenario was you understood about 95% of it, or you believed that you were 95% correct, but these 5% caused it to all go down.
Well, and if it was an equal weighted index, I would have made $1 million, but it wasn't. It was a cap weighted index and the biggest caps took off. And so it was the tail that wagged the dog. And so I was so proud of my analysis and I still lost $1 million.
Yeah, that's a tough situation there.
Yeah, it's the hardest part explaining it to your wife.
All right, Neil,
So,
you have one final question for Mr. Murphy.
yes, I think I'll ask him one more question. So, has there been a person in your life or in your career that you follow and really admire, and why and how did they impact you?
So there have been 2. One, he wouldn't know me. I've never met him. The other one I've met many, many times. So one, I've always respected Warren Buffett. He's just a very kind of consistent, unflappable, very thoughtful, careful investor. And thousands, hundreds of thousands of people have benefited because of Warren's career and his expertise. And so it's really hard not to honor a person like that and respect what they've done. Earlier in my career, I invested in a buyout fund and I got to sit on their advisory board. And this buyout fund was under the Robert Bass family kind kind of enterprise. And I got to meet Robert and visit with him on several different occasions. And I was just super, super impressed. Here was a guy that inherited some money along with his brothers, and each of the brothers had become multi-billionaires because one, they were very bright and they made a lot of good investments. But what I found was they surrounded themselves with really, really capable, bright people, even geniuses. And so I remember sitting at one meeting, I'm looking at the different people in the room, and I thought, wow, I can count 7 different people in this room who worked for Robert Bass, who are now billionaires on their own. And so to have an ecosystem that creates so much success takes a visionary person who really does things in a very strict and kind of organized and thoughtful way, and then surrounds himself. He's strong enough to surround himself with people that could be smarter than him. And then together they built a really tremendous investment business and portfolio, who's then spun out and created very, very other large investment businesses. I was just always impressed. He always was someone with great integrity and tremendous logic. And I just thought, I'd like to be more like that.
Okay, thank you so much, Mr. Murphy.
Yeah.
Neil, it was my pleasure. Congratulations on being the winner. That says a lot about your kind of fundamental abilities and hard work in that. And I think it's a great step forward for a very successful career.
Awesome.
Thank you.
Well, Brian, thank you so much for joining us today. It was a pleasure to have you on. And again, Neil, great job on doing the interview, and congratulations for winning that Shark Tank contest. Brian, if you can leave us with just words of wisdom, one piece of advice that you'd like to give to our high school students that are watching today.
Well, the one thing I've learned after my kind of 35-year career is that, one, this too shall pass, and things are never as good as you think they are when things are going well, and they're never as bad as you fear they are when things aren't going well. If you keep consistency, do the things for the right reasons, put your head down, work hard, have that good attitude, it will all work out over time. It might be really scary at the moment, but it will work out over time. And I've just found that time and time again in my career.
Great. I love that. Thank you so much.